Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Lucid.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine taking a boutique tailor, someone who hand stitches these incredible $100,000 luxury suits.
Right. Highly specialized.
Exactly. And then suddenly telling them, hey, you have exactly 2 years to figure out how to manufacture 1 million cheap t-shirts for Walmart.
Yeah, that is quite the pivot.
It's jarring, right? It's a nearly impossible transition. But that is the exact strategic pivot the company we are analyzing today is attempting.
It really is. I mean, for the longest time, you've probably known them as this niche, ultra-luxury automaker.
Oh, absolutely. Building cars that break engineering records, turning heads in affluent neighborhoods.
Yeah, but building a few thousand very expensive cars is just a completely different universe of operations than building a scalable mass-market fleet.
Which brings us to the crux of the investment thesis you need to evaluate right now. Because management is forcefully transitioning the company into, well, a high-volume mobility platform.
Right. They are targeting a massive production scale up to 100,000 electric vehicles by 2028.
100,000. That's a huge leap.
It is. And to put the financial implications of that into perspective for you, they're projecting this single pivot will expand their total addressable market from roughly $40 billion today to nearly $700 billion.
Nearly $700 billion.
Yeah.
700 billion.
That is just a staggering leap. But let's ground that number for a second.
Right.
Why does moving from luxury to midsize suddenly open up hundreds of billions in market share?
Well, because the ultra-luxury market is ultimately a finite pie. I mean, there are only so many consumers out there willing to spend 6 figures on a sedan.
Right, no matter how beautiful the engineering is. Exactly. The midsize market, where everyday consumers live, where fleet vehicles operate, where the bulk of global transportation actually happens, that is where the actual volume sits.
Okay, so to capture that, the company is relying entirely on what they call their midsize platform.
Yes, the midsize platform. This is the underlying architecture for 2 upcoming models they've announced, the Cosmos and the Earth.
Okay, so they want to build the Cosmos and the Earth to hit that 100,000 vehicle target. But, I mean, scaling manufacturing is famously brutal.
Oh, it's a nightmare.
Right. Like, we have watched brilliant engineering companies just completely fall apart the moment they try to speed up the assembly line.
The transition from custom-crafted to mass-produced is pretty much where the graveyard of automotive startups is located.
Exactly. So to capture a slice of that $700 billion pie, they can't just build an average mass-market car. They need an undeniable edge to survive those growing pains.
And they need to build it cheaper than the legacy giants. Yeah. I mean, they cannot outproduce the established automakers who have been, refining assembly lines for a century.
Yeah, you're not going to beat them at their own game.
No, so they have to out-engineer them.
Yeah.
And this brings us directly to their technological moat. They have a new hardware advantage specifically built around their Atlas drive unit.
Okay, let me stop you right there, because I see this term, Atlas drive unit, all over the analyst notes.
Sure.
But as an investor, I don't care about the name of a car part unless it moves the financial needle. So explain the mechanism here for us. How does one specific drive unit change the financial thesis for you and me?
It changes the thesis through the literal physics of efficiency. So in an electric vehicle, a drive unit essentially combines the motor, the transmission, and the inverter.
Okay.
And most companies lose a significant amount of energy as heat when they're transferring power from the battery to the wheels.
Just wasted energy.
Exactly. But the Atlas drive unit is engineered to minimize that thermal loss to an unprecedented degree.
So it basically runs cooler and wastes less energy. But how does that actually translate to the balance sheet?
It translates to the battery.
Yeah.
You have to remember, the battery is the single most expensive component of an electric vehicle.
Right. The raw materials are incredibly costly.
Yeah. So if your drive unit is hyper-efficient, you can achieve, say, a 300-mile driving range using a much smaller battery pack than your competitors.
Oh, I see where this is going.
Right. And when you put a smaller battery in the car, the entire vehicle becomes lighter. A lighter car requires even less energy to move, creating this positive compounding loop of efficiency.
Which means they spend significantly less money building the car in the first place because they're buying fewer raw battery materials.
Precisely. That mechanism is what creates a structural margin advantage.
Structural margin advantage. Analysts love that phrase.
They really do. But all it means is that the company has designed a product that is fundamentally cheaper to build from the ground up, regardless of how the broader supply chain fluctuates.
So, by utilizing the Atlas unit in the new Cosmos and Earth models, they can price the car competitively for the mass market while retaining a higher profit on each sale.
Exactly. A higher profit than a competitor who has to, you know, stuff a giant expensive battery into their car just to match the exact same range.
Okay, that structural margin advantage makes perfect sense. But that extreme battery efficiency isn't just good for consumer range, is it?
Not at all.
It's actually the exact technical requirement needed for a completely different initiative that has been driving a ton of recent market momentum.
Oh, the AI narrative.
Yes, the Dream Team AI narrative. Because there are circulating reports that they are quietly building an AI fleet ecosystem alongside Nvidia and Uber.
Yeah, this is a fascinating strategic divergence. And it really shifts how you should view the company's long-term trajectory.
How so?
Well, if you look at the dominant player in the space right now, Tesla, their entire philosophy is vertical integration. It is very much the Apple model.
They want to own everything.
Everything.
Yeah.
Tesla wants to build the physical car, write the autonomous driving software, design the AI silicon chips, and own the ride-hailing network.
A completely closed ecosystem.
Yes, where they control every variable.
Which is an incredibly expensive, high-risk game to play. I mean,
Yeah.
if one piece of that vertical stack fails, the whole ecosystem suffers.
Exactly, and the capital required to fund all those different disciplines simultaneously is just astronomical.
So how does this Nvidia and Uber alliance differ?
The strategy we are seeing with this alliance is entirely different. It is a modular approach. The company is essentially raising its hand and saying, hey, we don't need to write the software. We will just be the ultimate hardware layer.
Oh, wow. So think of them trying to become the Foxconn or the Intel Inside for the robotaxi world.
That is the perfect analogy. They provide the highly efficient physical vessel. Nvidia steps in to provide the AI brains and the supercomputing platform.
And then Uber steps in to provide the global distribution and the millions of active riders.
Exactly. It turns potential competitors into critical partners.
Okay, I see the logic there, but how does the Atlas Drive unit actually tie back into this modular AI stack? Like, why do they specifically need that efficiency?
Think about the power requirements of a robotaxi. The AI supercomputers required to process autonomous driving data like those Nvidia chips processing thousands of camera and sensor inputs every single second. They drain a tremendous amount of electricity.
Right, computing power takes literal electrical power.
Exactly. So if you put that supercomputer in an inefficient car, the battery drains rapidly. That means the Uber vehicle has to spend half its day parked at a charging station instead of generating revenue.
Oh, I get it. Because the Atlas Drive unit requires so little energy to move the car physically, there is abundant surplus energy available to power the AI compute.
Yes, without sacrificing time on the road.
So the efficiency isn't just a party trick, it's the foundational requirement for fleet economics. That is a really compelling narrative.
It is.
But I have to challenge this, because if we look at the broader market realities right now, we just saw Rivian strike a $1.25 billion deal with Uber for robotaxis.
Yes, that made massive headlines.
Right. So my question for you is, if Rivian is already out there signing billion-dollar distribution deals, is this modular stack thesis at risk of being completely crowded out before the Cosmos and Earth even roll off the line?
It's a vital question. And frankly, it is exactly why the broader market is viewing this space with such intense skepticism right now.
Because it's getting crowded.
Exactly. The Rivian deal proves that the robotaxi market is not a one-horse race. It is becoming heavily congested. Uber is actively shopping for hardware partners and spreading its bets across multiple manufacturers to avoid being locked into a single supplier.
So does that kill the thesis?
No, actually. The Rivian deal does not invalidate the thesis, it validates the demand.
How so? Walk me through that.
Because for a fleet operator like Uber, the only metric that truly dictates profitability is the cost per mile. If your vehicle goes further on a smaller battery, charges faster, and leaves more power for the AI, the economics for the fleet operator improve dramatically.
So the best hardware wins out in the end.
The market for fleet hardware is vast enough to support multiple players, yes, but the most efficient hardware layer will always possess a compelling value proposition.
And they also have that dedicated lunar robotaxi concept designed specifically around these exact efficiencies.
They do.
Huh.
So while the competitive pressure is very real, the underlying physics of their efficiency gives them a permanent seat at the negotiating table.
Okay, so the thesis survives the Rivian news, but it definitely highlights that they are racing against the clock.
Absolutely.
And to win that race, to build that autonomous hardware layer and actually scale up the midsize fleet to 100,000 vehicles, it requires an absolute mountain of cash.
An unbelievable amount of cash.
So let's address the bearish elephant in the room, the financial reality.
Yeah, we have to look clearly at the negative sentiment here.
Yeah.
There is a very vocal, very prominent, still not impressed perspective among financial analysts right now.
Understandably so.
And their argument is anchored in undeniable facts. Heavy, sustained financial losses and severe cash burn.
Yeah, for anyone who has invested in the electric vehicle sector over the last 5 years, cash burn are the two scariest words you can hear.
Because it is the mechanism of bankruptcy. It's how these companies die.
Right.
But you have to understand why the cash is burning. Transitioning to high-volume manufacturing is just famously capital-intensive. You're not just paying salaries. You're building physical factories.
Tooling massive steel assembly lines, establishing global logistics networks.
Exactly. All of those billions of dollars go out the door before you see a single dollar of revenue from the new cars you intend to build.
Right. But there is a very specific turning point approaching that alters this narrative. Management has firmly indicated that 2026 will be the final year of intensive capital investment.
Yes.
So for the listener trying to map out a timeline, why does the spending suddenly peak and drop off next year?
It all comes down to physical infrastructure.
Mm.
The massive, incredibly expensive transformation of their assembly plant in Saudi Arabia will finally conclude in the second half of 2026.
Okay.
Right now, they're pouring capital into heavy standing machines, paint shops, and robotics. Once that physical factory is built and the heavy lifting of the tooling is completed, the capital expenditure drops off a cliff.
Because they don't have to build the factory twice.
Exactly. This specific drop in spending is what paves the way for their target of achieving positive free cash flow late in the decade.
And while they are burning that cash to get to that 2026 finish line, they possess something that almost no other startup has.
A literal financial safety net.
Yes, their strategic partnership with Saudi Arabia's public investment fund, the PIF.
Yeah.
This backing is honestly their ultimate competitive advantage.
It really is.
I look at it like having a billionaire guarantor co-sign your mortgage while you are doing a highly risky ground-up home renovation.
That's a good way to look at it.
Having that co-signer doesn't guarantee your renovation will look good or that it will be finished on time, but it guarantees the bank is not going to foreclose on you while the walls are torn down.
The mortgage guarantor analogy is close,
Mm-hmm.
but there's a catch you really have to factor in.
What's that?
Well, a guarantor in a typical financial arrangement might walk away if the investment sours. But the public investment fund isn't doing this out of simple venture capitalism. It is a national strategic imperative for them.
Because Saudi Arabia is aggressively trying to diversify its economy away from fossil fuels.
Exactly. This company remains its core strategic electric vehicle asset. They view the success of this manufacturing plan not just as a line item on a spreadsheet, but as a pillar of their national economic transition.
Which fundamentally changes the risk profile for you as an investor. When you look at the broader landscape, there are dozens of electric car startups that have already gone completely bankrupt.
Oh yeah, capital markets dried up, interest rates rose.
And they couldn't fund their manufacturing scale-up. But the PIF backing essentially provides a hard floor for survival, dramatically de-risking a total bankruptcy scenario.
It entirely separates them from the rest of the startup pack. I mean,
Right.
even though the PIF recently reduced its exposure across its broader U.S. equity portfolio, it continues to inject liquidity here.
Right.
That dedicated capital pipeline is what ensures they can actually reach that critical 2026 inflection point.
Okay, so we have a clear line of sight to the end of the peak cash burn in late 2026. We have the physics of the Atlas Drive unit creating a structural margin advantage, and we have a sovereign wealth fund ensuring the lights stay on.
All the pieces are there.
Given all of that, let's look at how Wall Street is actually pricing this right now, because the technicals and the price targets represent a massive disconnect.
It's a huge disconnect.
Over the past 12 months, the stock has more than halved. It has washed out all the weak hands, deeply battered, and is consolidating at a support level well under $10.
Yet the current price action reflects absolute peak market pessimism. But what requires your attention here is the significant value gap between where the stock is trading today and where institutional analysts project it will go.
Tell me about those projections.
Major players like Stifel and Citi have recently set price targets of $17.
Wow.
Yeah, When you analyze an asset trading sub $10, a $17 target implies an upside of over 70%.
70%. That is a profound discrepancy between current sentiment and projected value. And we just saw Citi initiate coverage with a formal buy rating.
We did.
So for the listener who might just look at ratings as mere opinions, explain why a formal buy rating from a major bank actually moves the underlying mechanics of the market.
Because a rating from a bank like Citi is not just an opinion, it is an institutional trigger. Large mutual funds, pension funds, and algorithmic trading systems often have strict mandates.
Right, they have rules they have to follow.
Exactly. They might be restricted from buying a stock that has a consensus hold or sell rating. When a major institution initiates a buy rating and explicitly cites upcoming product launches like the Cosmos and Earth as their rationale, it fundamentally changes the momentum.
It gives portfolio managers the green light to start accumulating shares.
Yes, that is why you often see a stock pop, like the recent nearly 2% bump we saw here, just on the release of the note. It is the beginning of institutional buying flows.
Okay, so let me push back on Wall Street's logic here. If there is a 70% upside, according to these major analysts, and the bankruptcy risk is heavily mitigated by the Saudi PIF, why is there still such extreme pessimism priced in?
It's a fair question.
Why is the stock still sitting under $10? Is the broader market just entirely fatigued by electric vehicle startups constantly overpromising and underdelivering?
It is absolute fatigue combined with a demand for proof. The market has been burned way too many times by charismatic CEOs standing next to beautiful clay prototypes, only to watch the company collapse when they realize mass production is a logistical nightmare.
So Wall Street is firmly in a show-me phase.
Very much so. Institutional buyers understand the $700 billion total addressable market. They comprehend the physics of the Atlas Drive unit, but they are refusing to price that future success into the stock today.
They want to see the cars.
They want to see the physical cars rolling off the assembly line at scale, and they want to see the capital expenditures genuinely drop as promised in late 2026 before they commit serious capital.
Which makes the timeline incredibly important for you as an investor tracking this opportunity. Let's map out the specific catalyst calendar you need to be watching over the next phase.
Let's do it.
Starting with March 2026. This is the scheduled investor day. This is where Wall Street is going to demand a look under the hood at the unit economics of the midsize platform.
Yeah.
Before we go further, let's define unit economics simply, for anyone prepping for a meeting.
Sure. Unit economics simply means proving that you can build one single Cosmos vehicle for less money than you sell it for, factoring in all the materials and labor.
Makes sense.
If you lose money on one car, building 100,000 of them just accelerates your losses. So that March event is where management has to mathematically prove that the structural margin advantage of the Atlas unit translates to actual profit per vehicle.
Okay, so March is the math test. Then the next major catalyst hits in the second half of 2026. This is the physical completion of the Saudi assembly plant transformation.
Right. That is the physical test. This is the moment the narrative must shift from heavy cash burn to declining capital intensity.
If they hit that construction deadline, the capital expenditure falls.
And it validates the entire financial recovery thesis. It proves they can execute on physical infrastructure.
Okay. And then looking just over the horizon to 2027, we have the scheduled launch of their autonomy subscription service,
Which represents a fundamental shift in how the company is valued by the market. Currently, they operate on a transactional model. They sell a piece of hardware once, recognize the revenue, and move on.
But an autonomy subscription service creates a recurring revenue stream.
Exactly. Drivers or fleet operators pay a monthly fee for the software enabled by the hardware. This changes the margin profile of the business entirely.
Making the financial statements behave much more like a high-margin software-as-a-service company than a traditional capital-intensive metal bender.
Spot on.
That transition from transactional hardware to recurring software revenue is where valuation multiples historically explode. So bringing all of this together into a final investment thesis for you.
Yes, let's summarize.
We are looking at a company attempting a high-stakes, historically difficult transformation from a niche luxury brand into a scalable mass-market mobility platform.
Right.
They are armed with an industry-leading technological moat in the Atlas Drive unit, and they're backed by one of the wealthiest sovereign funds on the planet. When you weigh the incredible potential of the Nvidia and Uber modular AI alliance against the very real, very heavy ongoing cash burn and the brutal execution risks of mass manufacturing, how does this score?
based on the balance of those structural advantages versus the clear execution risks, this earns a bullish score of 7 out of 10.
7 out of 10. Okay.
The risk-reward setup is highly compelling, given the substantial value gap between the current sub-$10 trading price and the $17 analyst targets.
But it's not for the faint of heart.
No. Pursuing this requires a very specific investor mindset. The target horizon here is firmly a long-term hold, specifically looking at a 12 to 18-month window.
So you are basically buying the blueprint and waiting for the house to be built.
Exactly. You are holding through the peak capital expenditure phase of 2026, waiting for the execution of the mid-size platform, the Cosmos and the Earth, and waiting for the formalization of those modular autonomy partnerships to fully materialize.
And finally be priced into the stock by institutional buyers.
Yes.
It's all about having the patience to let the infrastructure mature. And that leads to a really profound paradigm shift you should consider as you evaluate this asset moving forward.
Oh, I like this. What is it?
Well, we have spent this time talking about them as a car company trying to scale up.
Right.
But if they successfully execute this pivot, if they get the Cosmos and Earth platforms running efficiently, and they truly become the hyper-efficient, modular hardware layer for Nvidia's AI brains and Uber's global distribution network, should you even evaluate them as a traditional automaker anymore?
That is the big question.
If their end game is providing the ultra-efficient physical nodes for autonomous networks, perhaps they aren't a struggling car company at all.
There's something entirely different.
Perhaps they are quietly positioning themselves to be an early-stage, pure tech infrastructure company powering the physical layer of the coming AI revolution. That entirely flips the thesis, and it is something to deeply think about as you watch these 2026 catalysts unfold.